Today we're covering section 11.4 on stocks, bonds, and mutual funds. Stocks, bonds, and mutual funds are all investment vehicles, but they do differ in nature, and we want to talk a little bit about how they do in fact differ. When owners of a company want to raise money, perhaps to expand, they may decide to sell part of the company. An investor who purchases part of the company is said to own stock in the company. A share of stock is a certificate indicating partial ownership in the company. The owners of the certificates are called the stockholders or shareholders sometimes. As owners, the stockholders share in the profits or losses of the corporation. A company may distribute profits to its shareholders in the form of dividends. A dividend is usually expressed as a per share amount, for example, say 7 cents a share. Here's an example. A stock pays an annual dividend of 84 cents per share. Calculate dividends paid to a shareholder with 200 shares of the company's stock. It's simple as it looks. Dividends are the price per share times the number of shares. So the price per share is 84 cents. The number of shares that the shareholder owns is 200. 200 times 0.84 is $168. So that stock would pay $168 annual dividend to that particular stockholder with 200 shares of stock. Dividend yield used to compare a company's dividends is the amount of the dividend divided by the stock price and is expressed as a percent. Determining a dividend yield is similar to calculating the simple interest rate earned on an investment, so it's a skill that you should already have. You can think of the dividend as the interest earned. The stock price is the principal, and the yield is the interest rate. So the amount of dividend is the same as the amount of interest earned in the I=PRT formula. The principal is the stock price, and the interest rate is the yield. And of course, the time is the same in both. For example, if I said a stock pays an annual dividend of $1.75 per share, and the stock is trading at $70, find the dividend yield. And it's simply applying the I=PRT formula. You were told that the annual dividend is $1.75 per share, and we talked about the fact that the amount of dividend can be equated to the amount of interest in the I=PRT formula. So the I becomes $1.75. The principal is the value of the stock. The stock is trading at $70, so the P would be 70. It's an annual dividend, so T would be 1, and we're solving for R. So 70 times 1 is 70, and if you divide both sides by 70, you get 175 divided by 70, which is 0.025, and if you change that to a percent, you get 2.5%. So if a stock pays an annual dividend of $1.75 per share, and the stock is trading at $70, that represents a 2.5% dividend yield. And basically, you're just using the standard I=PRT formula. The market value of a share of stock is the price for which a stockholder is willing to sell a share of the stock and a buyer is willing to purchase it. In other words, you have to have a buyer and a seller who will agree on a price, and shares are always sold to the highest bidder. A brokerage firm is a stock dealer who acts as your agent when you want to buy or sell shares of stock. The brokers in the firm charge commissions for their service, and most trading of stocks happens on a stock exchange. Stock exchanges are simply businesses whose purpose is to bring together buyers and sellers so they can exchange shares of stock. Here's a portion of a stock table showing some stocks from the Dow Jones Industrial Average from a day in 2015. Most of the column headings are self-explanatory. For example, if you look at the DIV, that stands for dividend, so that's the column that gives you the annual dividend for the stock in question, which is listed by row. Those first several columns relate to the particular day in 2015 that we pull this information from. Some of the other columns don't necessarily represent a day. For example, the 52-week high and low, that's obviously not just a day information, but the first few columns represent that particular day that it was chosen. Suppose you bought 500 shares of stock in General Electric at $22.08 per share, and then you sold them at the closing price of the stock on this day in 2015. If you completely ignore the dividends, what would your profit or loss be on that sale? You got to think about this. You go to the General Electric row of the table because they're asking about General Electric. In order to see what your profit or loss is, you've got to know two things. You've got to know how much the stock was worth when you bought it. You've also got to know how much the stock was worth when you sold it. Well, it told you you bought the shares at $22.08 per share, and you bought 500 shares, so obviously 500 times $22.08 tells you that the stock was worth $11,040 when you bought it. Well, how much was it worth when you sold it? It's still 500 shares of stock, but you need to know the selling price, and that's where you have to look in the table. So you go into the table and you look in the closing column and go down to the General Electric row, and you find out that the closing price of that stock was $29.36. So that's what you sold it for. So 500 times $29.36 comes out to be $14,680. So you bought the stock for $11,040. You sold it for $14,680. The difference, since it's positive, is a profit of $3,640. Had it come out negative, that would have been a loss. So if you bought 500 shares of stock in GE at $22.08 per share and then sold them on this closing date at $29.36 per share, you would have made a profit of $3,640. And it would be profit because that's a positive value. Had it come out negative, it would have been a loss. What's the broker's commission if she charges 2.5% of the total sales price? Well, what is the total sales price? The total sales price is that $14,680 that you received for selling your stock on that day in 2015. And if the broker charges 2.5%, that's 0.025. So if you multiply those numbers together, 14,680 times 0.025, you get $367. So the broker's commission on that transaction was $367. Now let's talk a little about bonds. When a corporation issues stock, it is selling part of the company to stockholders. When it issues a bond, the corporation is actually borrowing money from the bondholders. A bondholder lends money to the company. Corporations, government agencies, states, and cities all issue bonds. They need money to operate, for example, to fund the federal deficit, to repair roads, to build a new factory. So they borrow money from the public by issuing bonds. Bonds are often issued in $1,000 units. The price paid for the bond is called the face value. The issuer promises to repay the bondholder on a particular day called the maturity date, at a given rate of simple interest called the coupon. So the coupon is a simple interest rate. For example, a bond with a $10,000 face value has a 3% coupon and a 5-year maturity date. Calculate the total of the interest payments paid to the bondholder. Again, it's simply I equal PRT. It's a $10,000 face value, so that's P. The interest rate's 3%, so that's 0.03, and you're doing it for 5 years, so T is 5. So the amount of interest is 10,000 times 0.03 times 5, and that comes out to be $1,500. So a bond with a $10,000 face value at a 3% coupon and a 5-year maturity date will pay interest of $1,500 at the end of that 5-year period. A key difference between stocks and bonds is that the stocks make no promises at all about dividends or returns, but the issuer of a bond guarantees that provided the issuer remains solvent, it will pay back the face value of the bond plus interest. So the risk you run with bonds is that the company could go under. But as long as the company is solvent, it has to pay back the bond plus the interest. The stock market makes no guarantees at all. Mutual funds. An investment trust is a company whose assets are stocks and bonds. These companies do not make a product, but they purchase stocks and bonds with the hope that their value will increase. And a mutual fund is a type of an investment trust. Investors add money to an investment pool by buying shares in a mutual fund. Each share of the fund represents a fractional interest in each stock. So if you buy into a mutual fund, you are buying a fractional part of every stock that mutual fund owns. The investments in a mutual fund are called the fund's portfolio. Investors in a mutual fund share the profits or losses from the investments in the portfolio. Each day, the value of a share in a fund, the net asset value of the fund, or NAV, depends on the performance of stocks in the fund. And it's calculated as follows. The net asset value of a mutual fund, or NAV, is A minus L over N, where A is the fund's total assets, L is the fund's total liabilities, and N is the number of shares outstanding. So, for example, if I have a mutual fund that has $600 million worth of stock, $5 million worth of bonds, and $1 million in cash, and the fund's total liabilities are $2 million, and there are 25 million shares outstanding, and you invest $15,000 in this fund, I want you to calculate the NAV. NAV is A minus L over N. If you have trouble remembering all those letters, just think of it in words. The NAV is the total fund value minus the total liabilities divided by how many shares are outstanding. In other words, how many shares exist of that fund. So here the total fund value is the sum of the stocks and bonds and cash. You're told you have $600 million worth of stock, another $5 million worth of bonds, and then $1 million worth of cash. So $600 million plus $5 million plus $6 million is $606 million. So the total fund value is $606 million. The liabilities were given to be $2 million, so you put $2 million after the minus sign, and then you divide by the number of outstanding shares, which you were told was 25 million. So you've got 606 million minus 2 million, all divided by 25 million. And if you do that calculation, you'll come up with $24.16. So the NAV is $24.16. How many shares are being purchased and round down to the nearest share? Okay, to calculate the number of shares being purchased, all you do is take the amount of money you're using to purchase shares and divide by the NAV. So it says that we're going to buy $15,000 in this fund. So the value of the shares bought is $15,000. We just calculated the NAV to be $24.16. So the shares purchased would be the amount that you're using to purchase the shares divided by the NAV, which is basically the price per share. If you divide that, you end up, if you round down, as the instructions say, you end up with 620 shares.